Oh, okay. Now it is working. All right, cool. All right, thanks, guys. Hey, Al, what's up? Thanks for joining. Uh, Cody, Ray, thanks for dropping in here and telling me that my stuff's working. Steven, welcome. I will definitely get to that question that you're posting in there, and feel free just to load the chat up with some questions if you guys have stuff. I'll kind of monitor that and just scroll through it and try to get all those questions answered for you guys. Hi, Jill. Hope you're doing well in Vegas there. Appreciate you guys. This is great. And there'll be more people that kind of trickle in, but we've been doing a lot of these kind of monthly Q&A webinars, and I really enjoy doing them because it lets me kind of just get my voice out to a multitude of people all at once. And the reality is, if you have these questions, there's a lot of other people who have these questions as well. And so this think tank here certainly can be very helpful for people. So don't be shy when it comes to all that kind of stuff. And, let's just have a really productive call. I'm going to start out just today by talking a little bit about travel expenses. I get this question quite a bit when it comes to what you can deduct for travel purposes, and a lot of people like to try to figure out a way to make their travel expenses business related and something that they can expense through their business, which I totally understand, and have done a lot of business travel myself. So I just kind of want to talk about some of the tricks of the trade on that, and some of the rules that are out there when it comes to business travel. Now, what makes something a business day is if you were working 4 hours and 1 minute in that day. So if you spend a half a day working, then that kind of checks a box as a working day in wherever you've traveled to. So a lot of times I'll have people who like to, especially when I lived in Las Vegas, they would come to Las Vegas and they say, hey, like, I want to come meet with you so I can write my trip off. And I'd kind of welcome that. I'm fine with anybody that wanted to come meet with me, but I also wanted people to understand that just coming and seeing me for an hour didn't necessarily make it to where you can write your whole trip off. There had to be other work that went along with it. So just premise number one is that 4 hours and a minute in a day is a working day. Now, there's a little bit of tricks to some of this kind of stuff. So, let's just say you went Thursday, Friday, Saturday, Sunday. And let's say on Thursday and Friday you had meetings and wherever you were at, but then you decided to stay the weekend and hang out. All right, so the way the IRS would view that is they would say on Friday, Saturday and Sunday, those were not working days. But on Thursday and Friday, those are working days. So when it came to your flight and your hotel and that sort of stuff, you would be able to deduct half of that stuff because you had 2 out of 4 working days. Now, let's do something a little different here. Let's say that you stayed till Monday and you went Thursday through Monday. And you went and you worked on Thursday and Friday, and then you worked on Monday as well. Because you've bookended your working days, you would not have to count the weekend as personal days. You had to stay in that place so that you can work Monday. So in that situation, you would be able to write off all of your trip. So kind of a cool little trick there when it comes to business travel is bookending your working days if you want to stay through the weekend. So to kind of jump on that, can you write off travel expenses if you work remotely? As in, there's no reason to travel based on business, but I got more than 4 hours of work done each day while traveling. I feel like that's a little bit of a gray area, but if you are working, and there's a reason for you possibly to be working in that area, that could be fine. I don't know that we may have to dig into some cases and stuff on this, but if you took your family to Disneyland and you ended up like sliding away and went and hammered out 4 hours of work in the hotel room while everybody else was having fun, the nature of that probably isn't one to where I would think that you could deduct that. But that kind of gives me something interesting maybe to look at some cases on to see if there's anybody who's been challenged on that. So that's a really good question. Anyhow, but travel expenses are flights. They're going to be your lodging while you're there. It's going to be Ubers if you're going around, or a rental car, that kind of stuff. What happens if we meet with you less than 4 hours? Well, that would just be part of the working day. So, let's just say maybe you came and met with me for 2 hours, and then, maybe you linked up with a realtor, for example, and went and looked at properties for another 3 hours. That's a working day. All right. So you can have different elements of work, or maybe you had an appointment with me, and then you met with lawyers, and you met with somebody else. When we would have people who would come into Vegas, for example, they'd come meet with me, then they'd go meet with their attorneys at Anderson. So, maybe you'd have something like that happen. So really good questions around that kind of stuff. But this is a really common one, and kind of takes me into just another principle that I want to share with you today, is that anything that's ordinary and necessary in your normal course of business is something that is deductible. So a lot of people will reach out to me and they'll say, "Hey, I'm a notary. What can I deduct?" And I'm thinking, you can deduct everything that's related to be a notary. I mean, a lot of times I think we get into this spot where we think, hey, there's this set list of these 10 things that I can expense. And really, the rules, section 162 in the code, ends up saying anything that's ordinary and necessary is what you're allowed to deduct. So, I mean, that can kind of be taken a certain way. Is, well, what is that? I mean, yeah, it might be your vehicle. It might be, going and getting paper clips from the store. It may be getting computer paper so that you can print stuff, or nice pens so that the mobile notary can have nice pens when they go over to somebody's house. There's a lot of different things like that. So, and everybody's businesses are different. So there's never really been like this chart that is just like, here's what you can expense. But what the IRS says is anything that's ordinary and necessary in your normal course of business. So anyways, hopefully there's some nuggets in there for you guys on that. Certainly, Matt's given me something to think about a little bit more. And I'm going to jump into Cody's question. Cody's an S-Corp. He's a SaaS, software as a service company. We take disbursements from our payment provider one time per month. Our next disbursement is January 3rd. It's for December. Does this cause problems? All right. So there's two methods of accounting. One is the cash basis of accounting, and the other is the accrual method. Now, when you're cash basis, you record revenue when you receive it. So if you're receiving money in January for the previous December, you're actually going to record that revenue as of January 2023, because that's when you receive it. It doesn't really matter when you did the work, or when you invoiced, okay? So cash method, people love the cash basis of accounting because it really gives you some control on when you spend money, when you record money as income, and when you receive it, and that sort of thing. So I would say probably 95% of my clients are cash basis of accounting. And I like cash basis because it's simple and it gives us control. Now, to the other point, there is the accrual method of accounting. In the accrual method of accounting, you record as accounts receivable revenue when you invoice. And so over time, you may be invoicing. It doesn't necessarily matter when you receive that money. You just want to make sure that the job's completed and that it's invoiced. And so accrual is less common. It's a lot more complicated from a bookkeeping standpoint. But in your case, I would probably lead you to the cash basis of accounting and then record revenue as you receive it. All right, let's see. Is there any benefit to take business debt to reduce liability? For me personally, I'm not a big debt person, but there is some situations where possibly, going into some business debt can be helpful. Let me give you two examples. Example number one is going to be a scenario where, let's say you're sitting right here at the end of the year and you don't have a lot of cash right now for whatever reason, but you do have a big tax liability that's coming up. Let's say, for example, this year you made $500,000, but you ended up spending a lot of the money remodeling your house. And so now end of the year comes around, you realize you're going to have a $100,000 tax bill and you really don't have that cash, so you're looking for ways to reduce that income. So what we've done in the past with people is kind of look at something like bonus depreciation, which bonus depreciation allows you to write off 100% of something that you purchase. So maybe you're in the medical space and you need a new x-ray machine. X-ray machines cost $150,000 and you don't have $150,000. What you can do is go finance the x-ray machine, put down 5 or 10 grand, and then take a big payment on a monthly basis after that. But you'd be able to write off the x-ray machine right now. So you took your income down from $500K down to $350K and probably ended up saving about $40,000 in taxes. So in that scenario, maybe it is smart for you to say, okay, I'm going to take that debt because then it's going to allow me to have a really big write-off right now and get a piece of equipment that I really, really need in my business. And so that's one thing right there. It would be a scenario where I'm like, hey, maybe that is smart. Do I love having $140,000 of debt in your business? No, I really don't love that. And so what I would be suggesting in a scenario like that is perhaps you will build the money back up pretty quick, maybe in January, February, March, or pretty soon after that. You're kind of like, hey, we're in line for some good months and everything like that. I'm going to be able to pay down that debt and reduce that debt in a pretty fast basis. But when it comes down to like the timing of taxes and all of that sort of stuff, maybe there is a smart scenario where you do want to take some of that debt. Now, another thing that's worth mentioning is when you have business debt, the only thing that you're allowed to write off is the interest. So to me, it's kind of waste of money, but I still wanted you to know that like interest payments would be deductible for you in a case where you did have business debt. So just keep that in mind. Interest is deductible, but it's also something that never sleeps and something that you're always paying. So for me, I'm always going to kind of lean more on the conservative side when it comes to debt. Don't really take it unless you really, really need it. And, keep your financial strength when it comes to, how you operate. All right, let's see. It seems like in general, anything that is considered entertainment is non-deductible as a business expense. So 4 years ago in the Trump tax plan, they took entertainment out as a business deduction. And you used to be able to take clients to baseball games and, that kind of stuff, basketball games, sporting events, country club type stuff, golf events, just different things like that used to all be deductible at 50%. After the Trump tax plan came out, they put a kibosh on that. I think a lot of people were, maybe getting out of control with how much money they were spending on entertainment, but that was one of the concessions where it was like, okay, hey, we're doing 1, 2, and 3 to create a better, more competitive business environment, but when it comes to entertainment, that stuff's going to be non-deductible for going forward. Now, let's say, and I just did this last night. Let's say you go to a Utah Jazz game with a client, and you're out at the Jazz game. The purchase of the tickets are non-deductible, but let's say you grabbed maybe in the stadium, you got a pizza and you guys sat there and ate and talked business. that pizza that you purchased, even though you're at an entertainment venue, that is still going to be deductible for you. So don't forget that. And the meals are definitely deductible in the business sense. So keep that in mind. Sat Paul says, I'm not running payroll this year as I'm showing a loss. Can I take a distribution? Typically, when you're showing a loss, you do not need to run a payroll. So if you have an S Corp, if you're listening to this and you have an S Corp, you're wondering about payroll, do you need to take a payroll? If you have a loss, you're not required to pay yourself reasonable compensation. Most likely that distribution that you would want to take is going to be one that is money that has already been taxed, and it's just money that happened to be sitting in your corporate account. So you'd be fine taking a distribution even though you don't have a payroll and you just want to pull some money out of the company. All right, can you give some general guidelines about gifting related to stepped up basis versus estate taxes, especially with estate taxes limit possibly being reduced in 2025? All right, so yeah, this is always kind of an interesting one because it's debated quite a bit. The estate tax, when somebody that's worth $100 million dies, what ends up happening? The general rule here is that it's approximately $12 million right now is excluded from your estate. So, 100 million minus 12 million brings you down to $88 million. Then on that $88 million, it gets passed on to your heirs, but the estate has to pay taxes on the $88 million. So what people do throughout their lifetime is they gift, and they try to pass that on to their heirs before they die. That way this estate is not as big and the tax of like 35% is not implemented. So what's being asked here is give us some guidelines about gifting when it comes to real estate. Now, one of the really cool things about owning real estate is that when you die, whoever inherits the real estate gets an appraisal, and it doesn't matter what the original purchase price was. Whatever the appraised value is when you receive that, that's what it's worth, and that's what the basis is to your heir. So, this happens every once in a while. You buy a house for $100,000 20 years ago, and then you're holding on to it. Now it's worth $500,000. So if you were to sell it, you'd have a $400,000 capital gain. Now, if you hold on to it till you die, what happens, and you give it to your kid, now your kid gets it appraised for $500,000. That is what the value is for your kid. So if they sold it the next day for $500,000, there would be no capital gains tax on that. So what people are kind of doing, and something that I've always encouraged my real estate clients to do, is I'm like, don't ever sell your real estate. Like, hold your real estate till you die. And then, have your kids sell it right after you die if they don't want to manage it. And so the stepped up basis piece of it is a huge benefit when it comes to real estate ownership and selling. You can get rid of a big capital gain. Now, if you have enough real estate to where you're worried about the lifetime exclusion and all that sort of stuff, I mean, there is ways of doing some gifting, but a lot of times you're only allowed to really gift right now is $15,000. So you can give $15,000, your spouse can gift $15,000, and then you're allowed to give that to a single individual. So a lot of times what people might do is maybe it's a husband and a wife, and then their kid and their spouse. Well, you can give $15,000 to each person. So, it is possible to drain an estate quite a bit if you want to be smart about gifting. So in the case where somebody's maybe worried about a 12 million, or maybe in 2025 where, maybe legislation would be put in place where they reduced that $12 million annual exclusion or something along those lines, if you're worried about that type of stuff, it's probably a combination of working with an estate planner and working with a CPA. But I have some people who gift money to the spouse, their kid, and maybe like if their kids have kids, the grandkids, you could put money into their 529 plans or something along those lines. So there are some people out there who have worries about estates who gift to multiple people to try to reduce that number. So anyways, hopefully that's what you were looking for on something like that. There's some business travel that have some different rules when you're outside of the U.S. and some of the maybe those days calculations, some of that kind of stuff that I threw out there, some of that kind of stuff kind of goes out the window. But general guidelines are similar, but there are some differences in that are worth kind of going through. So if you have international travel or anything like that, I definitely encourage having some sort of conversation on that. All right. I provide discounted services for a nonprofit. Should I charge them the full price and then give them a donation back on what I would have discounted in order to capture a deduction? Other ideas, S Corp. All right, so going back to that cash basis of accounting. Cash basis of accounting is you're recording as income whatever you're being paid. So if you usually charge $100 an hour, but then you only charge $50 an hour, you're only going to pay tax on $50 an hour. Really, that spread between maybe doing something at a discounted rate for somebody, you're not really going to do anything with that. Now, if you were to go back and say, well, hey, you know what, I want to charge $100 an hour, the full price, but maybe what I'll do is if you pay me that $100 an hour, I'll turn around and make a contribution for $500 for the 10 hours of work that I did. I would not suggest that, because now that charitable donation, it's an itemized deduction. And depending on where you're at from standard deduction to itemized deduction, that donation may not actually help you that much. So in your case, if you are providing discounted services, I mean, one of the benefits is that you're just recording less revenue. And so you're not paying tax on your normal rate. But that phantom, maybe $50 an hour that I used in that example, that is not something that you're necessarily going to, receive any deduction for. Like you're not going to be able to do that because you're not recording the income. So, if you recorded $100 of income and then wrote off, $50, you'd be in the same place from a net income perspective, whether you just recorded the $50. So there really is no effect on that, but that's a really good question. All right, let's see what else is coming in. Let me just scroll through here and see if I missed anything here. I want to make sure. Okay. Steven says, as a realtor with a first-year LLC, is there anything that I need to do? Yes. We definitely want to have a chat depending on how good you're doing. Okay? Now, a lot of times maybe like when you're first-year realtor, maybe you're just getting off the ground and everything like that. I understand maybe the first year might be a slower year. But if you, from an income perspective, are over 30 to 40,000, we're definitely going to want to make sure that we make the LLC taxed as an S corporation. Especially if you have growth potential too, where you're like, hey, it probably is going to be 30 to 40, but it really might be more like 60 to 80, if you're in that spot where you're and I say that with a first year LLC, that's not just a realtor. Anybody that's in small business who's getting off the ground, if you think your LLC is going to generate more than $40,000, then an S corporation, making an election to have it taxed as an S corporation is probably a really good idea. The next thing that I would probably check in with you on, just being a first year business owner, is I would want to make sure that you have a business bank account set up and that you're not intermingling anything personally. I mean, I realize that sometimes it does happen, but and there's ways to correct that if it does. But I always want to make sure that somebody sets up a business bank account, because what ends up happening is bookkeeping is not going to be a big priority for somebody who's a brand new business owner. But if you've done everything that's business related through a business bank account, then it makes it possible 6 months down the road, 9 months down the road, when it comes tax time, for you to be able to go through and say, hey, you know what? I want to make sure that that I'm getting everything that I'm supposed to get. And so, having that business bank account is huge. If you're curious on what can I be expensing, it's a really quick conversation for me to go through that ordinary and necessary business expense situation for you. And so if you're on the fence about any of the types of expenses that you're allowed to deduct or how to deduct it and everything like that, that's something that we can kind of work through. And so, being that new business owner, that first, and a realtor specifically, where income is kind of hit or miss. I mean, you're going to have commissions here and there, and maybe you don't get your first deal signed for a while, or maybe you end up working with somebody else and have to split a commission and all that kind of stuff. I mean, there are some wrinkles there that are kind of at least important to understand. So, what I always say with the LLC owner is, for sure, once income goes over 40K, that's when you got tax savings potential is where you're going to be on that. And so, hopefully some of that is good advice. If you've set up the LLC, paid your business license, it's just kind of get to work and get out there grinding and make sure that you've got stuff in the pipeline and money coming in. So those are kind of like just huge pieces of advice that I would get for the new realtor. And if you are in that spot where you're going to go over 40,000, you're going to want to do the S Corp. You're going to want to run payroll. And so I have all the relationships on that kind of stuff, and it's one of those things that we can knock out for you. So for sure, great question. I know that's a question that a lot of people have. I get that stuff all the time. Now, just so you know, there are some videos in the Prosperity Society too, where we've put them in there where it's kind of, hey, I set up an LLC. What do I do next? How do I make it an S corporation? How do I sign up for payroll? What is bookkeeping? We've done videos on all that stuff, and that is in the platform. So, if you're not signed up, I would encourage you to sign up and go take a look at those. And they're short. They're 5 minutes each. Really direct and concise. If you run through those videos, you still have questions, we can definitely jump on and talk through it. I think I got through a bunch of the questions that people had. I'm wondering if there's any other stuff. Just an update on Prosperity Society that I will do. And I want to thank everybody for being on the live stream today. One of the things that we've really valued about Prosperity Society is just being able to put education out there and to put it in a centralized place that maybe doesn't have 10 separate articles with different varying information in it or anything like that that's maybe hard to go read about in like just your traditional Google search. But what I'm doing right now is I'm writing down a lot of the questions that you guys have, and we're working on making videos on those questions and loading them into the site. Right now we have 55 people who are signed up for Prosperity Society, which is just really cool because just like a month or two ago it was like 10. So it's starting to grow, the community's starting to grow, and as that community grows, our webinars that we're doing on here where we get, maybe 15 or 20 people are in and out of this watching right now, when that number gets to 50, 60, or 100, those questions that are going to come through are going to hit home even more. Now, I've put a lot of emphasis on tax planning, and I wanted to mention tax planning because every single year I will have somebody who is like, I didn't take advantage of tax planning. I'm sitting here in April with a big tax bill and I don't really know what to do. And I just want to make sure that people are equipped on this. And so, within the site, there's over 20 videos that are directly related to tax planning. And we're putting together more stuff. And if there's something specific that you want a video made of, I'm open to doing that. I'm happy to do that stuff for you guys. So anyhow, what I'm excited about is that there's 55 people in it. What I'm also excited about is that people are starting to view this content. And because there's so many people that are in it now, it motivates me to give really, really good content for you guys. So anyhow, keep checking out what we're doing and visit our site. I'd also would like for you guys to subscribe to our channel here. We've got 42 people subscribed to it. I think we can definitely do more on that. So I'd challenge you guys to do that. And I'm going to get back to questions now. So Steven, can I book an hour with you or your assistant to show how to really use QuickBooks? Yeah, we can definitely do that. And what I will say is that it will not be with me. I don't know. For whatever reason, QuickBooks Online, I mean, like, I can dig through it and pull reports that I need for taxes and all that kind of stuff, but I leave the bookkeeping to the bookkeepers. And so, I will jot that down and definitely, let you get a consultation with one of them who, can kind of run you through it. I don't know if you'll learn QuickBooks completely within an hour, but it'll be one of those things where you could probably get some education on it and get a good idea on how to do it. All right, Lacey, long time no talk. I'm glad you're on though. If I put my vacation home on the market to rent, is that considered when I placed it into service? Also, can I run a cost segregation on it in 2023 for 2022 deductions? Really good question. So, placed in service is kind of this key word. I like that you put it in quotations there, to where that is when the property is officially like open for business. You're in business, it's operating. Now, I would say that the general rule is going to be that when you put a renter in there, that's when it's going to be placed into service. It would be interesting to see if there's been any cases that challenge that, but not to my knowledge. Typically, it's going to be when somebody rents that. Now, if you place it on the market and perhaps you've just spent a little bit of time, maybe like fixing it up, and maybe you had somebody in there before and that sort of thing, I think that gives you a little bit more justification for being placed in service. But I would say if somebody maybe purchases a rental property today, they're hurrying up to try to get something in place before the end of the year, and then are trying to take a big like $75,000 deduction from a cost segregation, even though nobody's in it. I don't think that really would have some legs to stand on. But if it's already been something that you're using, you spent a month fixing it up, getting it rent ready for somebody else, okay, maybe I would look at something like that and think that's pretty reasonable for you to say that, hey, it's placed in service without a renter in there. So, that's kind of my thought on that. Now, as far as a cost segregation goes, just for the knowledge of the group here, a cost segregation is something that a team of engineers will go through a property and will produce a report for us that shows how to depreciate the property. And so the general rule when you're working with any accountants are going to say, hey, if you have a single family residence, it's a 27.5 year depreciation space. So, if you bought a home for, $300,000 and the land was worth $25,000 and the building was worth, $275,000, over a year's period, you would take $10,000 in depreciation per year. Okay? That's what the general rule is going to be on any single family residence. Now, people have been getting vacation rentals and they've been getting, warehouses and things like that. And, you don't want only $10,000 of depreciation. You want more depreciation than that. And so this cost segregation, a team of engineers will go through the property and they're going to say, oh, well, maybe $20,000 of this building is 5-year property, 5-year depreciation. Another $50,000 is 7-year property. Another $100,000 is 15-year property. And so instead of just doing the whole thing at 27.5 years and then doing $10,000 a year, which is the general rule that most accountants are just going to apply, this cost segregation gives accountants a map to say, okay, there's been specific things that have been done through this building, and the engineers have told us that we can accelerate depreciation. So now instead of getting $10,000 per year, you're going to end up getting maybe bonus depreciation on all the 5, 7, and 15-year stuff and get a really big deduction up front and then, maybe smaller deductions after that, just depending on how we do it. So your point and your question, can you do the segregation in 2023 and have it count for 2022? Absolutely. All right. The segregation does not have to be performed within the year. It just needs to be performed before you file your tax return, obviously. So that can run into 2023. So yeah, the interesting question there. I like that question. I think there's a little gray space in the first part of your question that we would want to probably do a little more looking at your specific situation. But yeah. And if you need connection on somebody to do a cost segregation, let me know. I've got a good person that I can refer you to. All right, when you do a cost segregation on your rental home, is there a certain time frame? First year, second year? To make it clean, Shelly, I like doing it in the beginning. If you end up doing it down the road, you can definitely go back and claw back depreciation deductions that you should have received in previous years. If you can do it within the first year, I like doing it. Now, for planning purposes, though, let me just bring this up since we're talking a little bit about cost segregation, and this did just come up today. If your plan is to sell the property pretty soon, it may not be worth it to do a cost segregation. You're going to hear people out there who are saying, like, you got to do a cost segregation. It gives you huge depreciation deductions. Well, your specific situation also does matter on that. And I want to just make sure that you know that. I mean, if you're a passive investor in real estate, and then cost segregations don't help you because you have passive income. And until you have passive income, you can't take passive losses. So for some people, a cost segregation doesn't work. If you have vacation rentals, then there is a benefit for you because the IRS views a vacation rental, an Airbnb, for example, as active Schedule C type income. It's not your typical rental type property in that situation. If you're a real estate professional, cost segregations definitely help you. So there's some different scenarios there where maybe it is good, where it isn't good. So I want to make sure that you know that. But in your case, Shelly, where you're asking the question, first year, second year, does it matter? For cleanliness, for straightforwardness, ease, and all that sort of stuff, I like doing it the first year. That way the depreciation's kind of locked in. It's hard to kind of just go back and change it and that sort of thing. But you can do an accounting method change and fill out a 3115 form and go through and do the calculation of what the depreciation should have been in the previous years and take that now. So if you're sitting here thinking to yourself like, man, I have this warehouse, I should have done a cost segregation a few years ago, but I didn't do it. You're not out of luck. Like, you can still run that, and that is something that we would encourage real estate investors to do. All right, let's see. Anything else? This has been fun. I encourage you, if you are not part of Prosperity, jump in this. This is something that I'm committing to. I love this type of stuff. This is the kind of stuff that's a lot of fun. Maybe you see a little goofy smile on my face when I'm talking about, being able to consult on tax and talk about tax and do it in a way where I can reach a lot of people. That is going to help the success of not only just my private practice in tax, but I think it's going to help a lot of people who are not who are not even my clients. And so, our goal is to build this out. We'd love for you to tell your friends about our monthly webinars and that sort of thing, and to take a look at our site. And if you have any questions about how it all works, then feel free to just let us know on that. But you guys have been great. Thanks so much for the questions that have popped in today. This has been a really fun call, and I look forward to doing it again next month. One of the things that I've gotten some feedback on is because this year we've done a webinar almost every month. But I think one of the things that I've gotten some feedback on from people lately is that they would love if this was calendared. And so what I'm going to end up doing for the upcoming year is each quarter I'm going to send out when we're going to do each of the live streams. That way you have time to prepare for it and be a part of it. So if you have any other feedback for us, we are open to that feedback. If you don't like the gray hoodie that I'm wearing because it's too casual, let me know. If you have ideas that you think could really make our platform better, I am totally open to that, and some of you have given me some. So keep that stuff coming. Keep those questions coming. Thanks so much for the time today.